Have you ever wondered what holds the world's financial system together? For decades, a crucial pillar of that system has been the relationship between the two largest economies, the United States and China. America spends and China lends, buying up trillions of dollars in U.S. government debt. It was a cycle that seemed unbreakable, a cornerstone of global finance. But what if I told you that cornerstone is not just cracking, it's being deliberately dismantled? China is dumping U.S. debt, not just trimming its holdings, but completely liquidating them. This isn't a gradual slowdown, it's a full-scale strategic exit. The latest data reveals a jaw-dropping trend. From a peak of over $1.3 trillion, China's holdings of U.S. Treasury bonds have plummeted to their lowest levels in over a decade. In fact, if you account for holdings through custodian accounts in places like Belgium and Luxembourg, the real number is likely even lower, possibly close to zero. The era of China as America's biggest banker is officially over. So why is this happening now? And what does it mean for you, for the U.S. economy, and for the world? This isn't just about numbers on a spreadsheet. This is a story about a massive power shift, a geopolitical chess move with profound consequences that are being deliberately hidden from the public eye. Stick with me as we uncover the hidden reasons behind China's great financial escape and what it signals for the future of global power. To understand the magnitude of this shift, we need to rewind a bit. For years, the arrangement was simple and mutually beneficial. China exported massive amounts of goods to the U.S., accumulating huge piles of U.S. dollars. To put those dollars to work, they bought U.S. Treasury bonds, which are essentially loans to the U.S. government. This helped keep the value of their own currency, the yuan, stable, making their exports cheaper. For the U.S., this fire hose of foreign cash meant the government could spend far more than it took in through taxes, funding everything from military operations to social programs while keeping interest rates artificially low. It was the ultimate have your cake and eat it too scenario for Washington. But that symbiotic relationship has soured. The turning point was the escalating trade war, followed by a series of geopolitical tensions. From Beijing's perspective, holding trillions in U.S. debt started to look less like a safe investment and more like a strategic vulnerability. What if the U.S. decided to weaponize the dollar? Look at what happened to Russia's foreign reserves after the conflict in Ukraine. Hundreds of billions were frozen overnight. For China, the message was loud and clear. Your assets are only safe as long as you stay in Washington's good graces. Holding U.S. debt became a massive liability, a financial hostage situation they were determined to escape. So, the great sell-off began. But China is smart. You can't just dump $1 trillion of anything onto the market without crashing its value and shooting yourself in the foot. The process had to be careful, quiet, and strategic. They began selling off their direct holdings while simultaneously using proxies and offshore financial centers to mask the true scale of their exit. It's a financial sleight of hand. While official numbers show a decrease, the behind-the-scenes liquidation has been far more aggressive. They are systematically de-dollarizing their reserves, moving away from U.S. assets and into something they consider far safer. And what is that safe haven? Gold. While China has been dumping U.S. debt, its central bank has been on an unprecedented gold buying spree. For over 18 consecutive months, China has been the world's largest official buyer of gold, adding hundreds of tons to its reserves. And these are just the officially reported numbers. The true amount is likely much, much higher. Why gold? Because gold is a physical asset. It's nobody's liability. It cannot be frozen or devalued by a foreign government's decree. It is the ultimate financial insurance policy in a world of growing uncertainty and geopolitical rivalry. China is trading paper promises from its biggest rival for a timeless, tangible store of value. This isn't just an investment strategy. It's a declaration of financial independence. So, what are the consequences of China no longer bankrolling America's spending habits? The immediate effect is on interest rates. Who is going to buy all the new debt the US government needs to issue to fund its massive budget deficits? With the biggest buyer stepping away, the US Treasury has to find new lenders. To attract them, it has to offer higher interest rates. This is not some abstract economic theory. It directly impacts your wallet. Higher Treasury yields mean higher mortgage rates, higher car loan rates, and higher credit card interest. The cost of borrowing for everyone in America goes up. The era of cheap money that we've all grown accustomed to is coming to an end, and China's exit is a major catalyst. Furthermore, this puts immense pressure on the Federal Reserve. With fewer foreign buyers, the Fed may be forced to step in as the lender of last resort, essentially printing money to buy US government debt. This process, known as quantitative easing, leads directly to inflation. It devalues the dollar, making everything you buy more expensive. It's a vicious cycle. The government spends more, the Fed prints more, and your purchasing power evaporates. We are already seeing the painful effects of inflation, and this structural shift in global finance will only add fuel to the fire. But the implications go far beyond your personal finances. This is about America's position in the world. The US dollar's status as the world's reserve currency has given the United States what former French President Valéry Giscard d'Estaing called an exorbitant privilege. It allowed the US to run massive deficits and exert unparalleled influence over the global financial system. China's divestment is a direct challenge to that privilege. It's one part of a broader strategy shared by other countries like Russia, Brazil, and Saudi Arabia to create an alternative financial system that is not dependent on the US dollar. They are developing new trade settlement platforms and promoting the use of their own currencies in international transactions. This move is accelerating the trend toward a multipolar world. We are moving from a system dominated by a single superpower to one with multiple centers of influence. The financial decoupling between the US and China is not just an economic event. It is a seismic geopolitical shift that will redefine global alliances and power dynamics for decades to come. The unipolar moment that began after the Cold War is definitively over. And the battle for what comes next is being fought right now in the bond markets and central bank vaults around the world. For years, many analysts dismissed the idea that anyone could realistically challenge the dollar's dominance. They were wrong. They underestimated the strategic determination of countries like China to break free from what they see as US financial hegemony. The liquidation of US debt is the most concrete evidence yet that this is not just talk. It's a calculated, long-term plan that is already well underway. The consequences are no longer theoretical. We are living through them. Higher borrowing costs, persistent inflation, and a more volatile and uncertain geopolitical landscape are the new reality. The key takeaway is this: the financial architecture that defined the last 40 years is being dismantled brick by brick. The silent, steady flow of capital from east to west that powered American prosperity has been reversed. China has made its choice. It is prioritizing its own financial security and strategic autonomy over propping up the US financial system. This isn't a temporary dip or a market fluctuation. It is a fundamental, irreversible break. As we move forward, we must all be aware of this new reality. The world is changing, and the rules of the financial game are being rewritten before our very eyes. Understanding this shift is the first step toward navigating the turbulent times ahead. Thank you for watching. If you found this analysis insightful, please hit the like button, subscribe to the channel, and ring the bell for notifications so you don't miss our next deep dive into the forces shaping our world. What do you think about China's exit from US debt? Let me know your thoughts in the comments below. See you in the next video.